So there's this guy on TikTok who says he flew business class to Tokyo for free using a secret credit card hack. And look, I hate to break it to him, but it's not a secret. It's called credit card churning, and roughly 47% of finance TikTok has made a video about it in the last 6 months. But here's the question nobody's actually answering honestly. In 2026, with banks getting smarter, algorithms getting sneakier, and rules getting stricter, is churning actually still worth it? Or is it a great way to torch your credit score for a free hotel stay in Cleveland? By the end of this video, you'll know exactly how it works, what changed in 2026, and whether you should even attempt it. Let's get into it. What actually is churning? Okay, quick definition so we're all on the same page. Credit card churning is basically this. You open a new credit card, not because you need it, but because it's dangling a juicy sign-up bonus in front of your face. Like, spend $4,000 in 3 months, get 75,000 points. You hit the spending requirement, ideally with money you were going to spend anyway, like groceries and gas. Collect the bonus, and then either keep the card, downgrade it, or cancel it before the annual fee hits. Then, you repeat. New card, new bonus, repeat. That's the churn. And is it legal? Yes, completely legal. Banks design these bonuses to attract new customers, and as long as you're honestly meeting the terms, there's nothing shady about it. You're not tricking anyone. You're just really good at reading the fine print, why people do it. Now here's why people get obsessed with this. A single sign-up bonus can be worth $750 to over $1,000 in travel value, like the Chase Sapphire Preferred, which regularly offers 60,000 to 75,000 points after a $4,000 spend. Value that can exceed $1,000, way more than its roughly $95 annual fee. Multiply that across a year, and disciplined churners are pulling in anywhere from 250,000 to 500,000 points annually, enough for multiple international business class flights. That's the appeal. That's why your cousin won't shut up about points optimization at Thanksgiving. But, and this is important, 2026 is not the same game it was even 2 years ago. Section 3. What changed in 2026? The plot twist. Here's where it gets spicy. Banks aren't dumb. They've noticed millions of people gaming their bonus systems, and in 2026 they fought back hard. First, banks are now using AI to detect patterns of rapid card applications followed by quick closures. Basically, an algorithm watching your behavior like a suspicious X. Second, issuers are using more sophisticated behavior models to flag anything that looks like bonus gaming or low lifetime value customer patterns, and enforcement can mean bonus denial, account closure, or even point clawbacks. That's right, they can take your points back. Third, the classic rules still apply, they're just enforced harder. Chase's 524 rule means if you've opened 5 or more cards from any issuer in the past 24 months, you're basically locked out of new Chase cards. And American Express only lets you get most sign-up bonuses once per lifetime, per card. So the days of opening 8 cards in a weekend, like some unhinged points wizard? Over. In 2026, churning is less about volume and more about precision. Conservative pacing and genuine spending behavior matter more now than raw application count. The real risks. Nobody talks about. Let's talk about the stuff the "I made $10,000 in points" influencers conveniently leave out. Risk 1. Your credit score takes hits. Every single application triggers a hard inquiry, which can temporarily drop your score by 5 to 10 points. And opening new accounts lowers your average account age, a factor lenders actually care about. Open 5 cards? That's a real dent. Risk 2. It is genuinely a part-time job. You have to track application dates, minimum spending deadlines, annual fees, and bonus payout dates. Most serious churners keep a spreadsheet just to avoid accidentally missing a deadline or eating an annual fee they didn't mean to pay. Risk 3. And this is the one that actually ruins people. You must pay your statement balance in full every single month, without exception. If you carry a balance, interest charges will immediately wipe out any value from the points. A $1,000 bonus means nothing if you're paying 24% interest on a balance because you overspent trying to hit a minimum. This is not a strategy for someone who struggles with credit card debt. It's a strategy for someone already financially disciplined who wants to optimize spending they were doing anyway. So, is it actually worth it in 2026? Here's my honest breakdown, no fluff. Churning is probably worth it if you already pay your full balance every month, you have decent to good credit, you're not planning to apply for a mortgage or car loan in the next 6 to 12 months, and you actually enjoy tracking spreadsheets and deadlines. Churning is probably not worth it if you carry a balance ever, you hate admin work, you're planning a big purchase soon where your credit score matters, or your strategy is just vibes and Reddit threads. If you're going to try it, start with one card. The biggest mistake first-timers make is opening 3 cards at once. One card, one bonus, one spending window until you actually learn the rhythm. And before you apply, add up your last 3 months of normal spending. If it comfortably covers the minimum spend requirement, the bonus is basically a real rebate on money you were already spending. If it doesn't, pick a smaller bonus instead of forcing it. So no, churning isn't dead in 2026. It's just gotten smarter, and it demands that you get smarter too. It's not a get-rich-quick scheme. It's a discipline game with a rewards multiplier attached. If this helped, smash that like button. I know, everyone says that, but it genuinely helps this channel grow. Comment churn if you want my full breakdown of the safest cards to start with in 2026. And subscribe because next video I'm covering the credit repair companies that are basically legal scams. You do not want to miss that one.